Jerome Powell playing a psyop on us. Good old Jay Powell from the Federal Reserve gave us a rug tug yesterday, not a rug pull. We were expecting a rug tug, not a rug pull, but we were wrong in where that tug came from. We got a little tuggins on the long end of the curve, not on the shorter end, where we were expecting to see some revision up. But is this potentially all part of Jerome Powell's psyop? Today, the day after the Fed meeting, we consider exactly that. See, one of the things that was driving me to believe that we would get a rug tug, not a pull, because Fed doesn't want to have to dramatically cut. We did talk about that beforehand. But one of the reasons that led us to this conclusion was the financial conditions chart. Look at this very closely. When you see the red line, you could see that the federal funds rate skyrocketed. And initially, the financial conditions via the Bloomberg Financial Conditions Index in this chart rose in line with the Fed funds rate. This makes sense. But what has happened since then? Well, even if you take out the banking crisis over here, you could see that since about the third quarter of 2022, financial conditions have actually loosened substantially. We've come straight down on financial conditions. And so this led me to think Jay Powell might want to tighten these up a little bit. How could we be standing at levels as low as 2014 and 2018 when inflation was running at 1.7%? And we were trying to prop up inflation, not prop down inflation. How could we not tilt hawkish? Well, we were wrong. Jay Powell did not tilt hawkish. And so the question is, why? Why did he not tilt hawkish on the short term and only gave us a little rug tuggins on that long term? Why is that? Well, one of the reasons he could be doing this is psychological. By keeping the Fed funds rate stable for longer, as we've heard, he's prepared to keep these rates high at this level for the foreseeable future. At 5.25% to 5.5%, what we're doing is we're sending a signal to people that psychologically says the Fed is fighting inflation. But what is the Fed doing at the same time? They're propping up the economy and jobs by allowing financial conditions to loosen. That's the only explanation I could think of here, is that psychologically, he's doing this. He's going to your face, I'm fighting inflation. And over here, he's got there's like a fire and it's the economy and jobs and he's pouring gas on it. So he's kind of like, see, look, I'm fighting inflation. I'm fighting inflation. And he's actually purposefully trying to stoke the fire of the economy to stick the soft landing. Remember, that's what gets Jay Powell his statue in people's front yards, is solving inflation while not having a recession. You kill the fire over here, yes, inflation will go away, but then you've killed the economy. And then you have massive joblessness, which is bad. So what do you do instead? You try to stoke this in the background, and in the foreground, what do? You fight inflation. Oh, fighting inflation. Basically, it's the perfect psyop. The same is true with quantitative tightening, slowing. Okay, now that's a fancy phrase. You don't have to so much worry about that. But the slowing of QT coming is another way of actually loosening financial conditions even more. And so now I'm starting to think, oh my gosh, I think this is the plot all along. This is the point. Pretend you're fighting inflation, which that hurts interest rate sensitive stocks. We know that. At the same time, purposefully drive financial conditions looser. What does that do? It leads to more lending, more stock buying pressure, more bond buying pressure, more business spending, more credit, more debt, and bond buying pressure is useful because the Treasury keeps issuing so they can give billion-dollar grants to Intel and other companies and fund these exploding deficits. So, as they say, don't fight the Fed. And the Fed yesterday proved to me that the Nike swoosh can hold. Now, that doesn't help interest rate sensitive stocks, right? We wrote that here at ehack.com. Remember, I like posting our research and our company's sort of news updates over on ehack.com. You could see that for free down in the Fed section in green. But anyway, what are the next catalysts and what does this really mean for us from a practical point of view? Well, if the Nike swoosh can continue, then from a practical point of view, what it is, or what we're hearing, is the Federal Reserve will continue to prop up probably your Mag 6. your Apples, your Microsoft, your Google, your chip makers, your chip designers, your Nvidia. The economy can keep booming on that note. Maybe even your SaaS businesses, you can keep booming. The companies with earnings that are growing can keep booming. The companies with negative earnings are the ones getting whacked. In fact, if you look at cumulative returns in the S&P 1500, and you compare them between, again, those companies with negative earnings and momentum stocks or companies with growing return on equity, what are you getting? Well, you're getting a very clear divergence. Momentum or return on equity stocks are absolutely killing it, whereas any kind of negative earnings company is getting destroyed. What kind of companies have negative earnings? Well, mostly small caps that are getting buried under the weight of high interest rates, or large caps, that medium and large caps, which are interest rate sensitive, where their customers get buried under high interest rates. And so that leads to negative earnings. When we hear about negative earnings or potentially negative deliveries for Teslas or whatever, people start pricing that in by going short those stocks. Oopsie doopsies. Now, when it comes to something like Apple, for example, I've personally been really tempted to buy the dip. I'm not too worried about the DOJ suit because it really, what it says is Apple is winning. Now, 31% of Apple's bottom line does come from services, and a good chunk of that comes from the App Store. They do still make most of their money from products. And so, yes, forcing some kind of reduction in services, potential revenue here could hurt Apple. But I think a 3.6% sell-off where we sit right now is a potential buy the dip opportunity. I've been thinking about buying the dip on Apple, but then it ran up to 178, and I'm like, now it's back to 172, pretty close to that 169, 170 floor or support level we've seen. Tempting. But anyway, and keep in mind, if you want alerts for all of my trades, buys, sells, you name it, long-term, short-term, whatever it is, make sure to join the Stocks and Psychology of Money group, which we have a price increase on tomorrow evening at midnight. So get in before 11:59, and if you have questions, email us at staff@meetkevin.com for bundle-up inquiries. But anyway, this financial condition PSYOP, I think, is something that we really have to internalize as, okay, the Fed doesn't need to help interest rate sensitive stocks, and at the same time, they can help all of the other stocks by fueling the fire of loosening financial conditions. The buy now, pay laters, the financials, the PayPals, the Affirms, the Targets, the Macy's, the Home Depots. It doesn't matter. You can literally support everything except the interest rate sensitive stocks. And you still send the signal, the psychological signal that you are fighting inflation. Because that's what you're doing. You're sending the message. At the same time, QT slowing and the loosening of financial conditions, not even getting a mention by Jay Powell. Well, other than like, oh yeah, financial conditions are helping tighten inflation. Really, bro? Have you looked at the financial conditions chart? They're not helping. Maybe it is just all supply side. Either way, pay attention to that. Next catalyst to pay attention to. The next PCE and CPI reports are going to be particularly important, as well as the jobs report. Maybe less so PCE. I would probably put it more on JOLTS, jobs, and CPI. That's April 2nd, 5th, and 10th. The reason for that is they are either going to prove that Jerome Powell was right to dismiss January, February, or wrong. And that will change everything for the May 1st Fed meeting. So mark your calendar for those dates. Obviously, I'll be live streaming all of those. And I live stream those. Some people aren't aware, but I live stream them on the Meet Kevin Live channel. So if you haven't gone to Meet Kevin Live, it's a different channel, and that's where I live stream all of these, generally at about 5:25 in the morning. Every day the market is open. It's realistically more like 5:26 a.m., but yeah. So anyway, thank you so much for watching. What do you think? Is this just the Fed PSYOP? Is this all part of the plan? Because I don't think we can be kidding ourselves that Jay Powell is unaware of the shenanigans that are going on here. I think he knows damn well what he's doing. And I think he's doing it on purpose to prop up GDP while saying, don't worry, we can have a stronger GDP while inflation is falling.
Advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than househack, nor am I presently acting as a market maker. Make sure if you're considering investing in househack to always read the PPM at househack.com.